Okay. So just to look at a couple of things about the unit trust industry in Sri Lanka. You can see that the unit trust industry in Sri Lanka is extremely small. To put it in context, like if you look at last year's annual report, right? Because this year's annual report is just about to be out, but I don't think it's out yet. Look at the banking sector. Look how big the banking sector is. 23 trillion rupees of assets, right? Of which commercial banks and specialized banks together are 19 trillion worth of assets. 19 trillion. Look at finance companies. Finance companies, 1.8 trillion worth of assets. EPF, 3.5 trillion. ETF, 468 billion. Insurance companies, 1 trillion, close to 1 trillion, 947 billion. Look at the unit trust companies, 153 billion, right? Total assets under management. That's here. Of course, the industry has more than doubled last year. You can see. And there has been a steady growth, especially because of the interest rate differentials that have been offered, right? But we are still far below in terms of, if you look at the unit trust industry, Sri Lanka is still far below where the banking sector is. And we talked about last time the importance of saving and the importance of investing. And you can see how little importance there is in terms of investing when you look at, in context, the amount of money that is there in each type of asset class or sector, right? And even in this unit trust, if you look at, here I've just put as equity funds, which are tiny. You see the amount of equity funds in Sri Lanka is negligible, about less than 20 billion. That's the total equity funds in Sri Lanka, unit trust funds. Everything else is fixed income. And even within fixed income, a major portion of this, over 300 billion, would be money market funds. That leaves less than 50 to 100 billion maybe in other types of fixed income funds. So if you look at the unit trust growth, really most of that growth has come from money market funds. And I told you last week, money market funds are not the ideal vehicle for investing. It is a vehicle for saving, not for investing. Right? So still we haven't broken out of that mentality of saving going towards investing. That's what we see in a lot of the time when you look at the distribution of where the funds are in Sri Lanka. So we have overall 16 unit trust fund management companies. They are there in the UTASL website. The UTASL website is where we get the fund prices daily from for your assignment. So they are there in the UTASL website. And in general, for unit trust, minimum investment is 1,000 rupees with front-end fees, if applicable, not exceeding 5%. Right. Generally, most fund management companies keep the minimum at about 5,000 rupees. Some fund management companies have higher thresholds depending on the size of the funds. Okay, so like 1 million rupees or 100,000 rupees, depending on the fund management company. Trustees, generally in Sri Lanka, trustee role is carried out by HNB, BOC, Deutsche Bank, NSB, right? And then if you look at the Securities Exchange Commission, they are the ones who are entrusted with the responsibility of protecting overall investor rights. So they're the regulators of the industry. And now unit trust funds are part of what we call collective investment schemes. So it's a part of what we call collective investment schemes. And there is a new code that SEC has put in terms of regulation called the CIS code, the Collective Investment Scheme Code, which governs the rules and regulations of how the funds should operate. So within, like if you look at all the regulation that governs unit trust funds, you have regulation imposed by the SEC. Like for example, the CIS code, right? SEC is the one who grants licenses in terms of unit trust. They are the ones who approve the new unit trust funds that come and in terms of registration, licensing and all that, as well as they're the ones who will look out for the advertisements and the promotional material that are published by unit trust. And generally, for a unit trust fund to say that it's broad-based, at least you have to have 50 unit holders. Otherwise, the SEC will ask you to wind up the fund or give you a certain period to bring it up to 50 unit holders. If you can't over a certain period of time, you might not be able to operate the fund because it is then not a collective investment scheme, right? It is not a pooled fund by multiple investors. So in terms of other restrictions that are imposed on the fund, SEC itself has certain restrictions. For example, there are maximum exposure restrictions, like in general, 15% to a company that is listed or rated. If it is not listed or rated, you might have to get separate commission approval. If it is listed but not rated, maybe it's 10%. So there are different regulations that are there in terms of maximum exposures that you can take. There are even more stringent regulations in terms of money market funds because money market funds have to provide liquidity. So there are liquidity requirements that the SEC imposes now with the new CIS rules. This is what I was talking about last week, where we said 5% of the fund has to mature within 1 day, overnight basis, 10% of the fund within 1 week, and 20% of the fund within 1 month. This is to ensure that money market funds have enough liquidity to safeguard investor interest because they are coming there for liquidity purposes, right? In addition, the fund itself, the fund manager, and the fund itself might have additional restrictions that they have because of their investment objective. For example, if it's a fixed income fund, you can't invest in equity, right? So you can have your own restrictions, which is clearly outlined in the trust deed of the unit trust fund, as well as what we call the key investor information document, the KID, the key investor information document. So on your side, as an investor, usually most fund managers will publish on a monthly basis the key features of the fund and the key investments that they have made, right? Or at least the credit rating of the companies if it's fixed income funds. So they will make available certain reports. Usually these small snippets of information in the form of fact sheets come out every month. And then you have your quarterly financial statements that are available, as well as on an annual basis, your audited financial statements are available. And these are mandatory to be published. They are available for existing unit holders on the websites of most fund management companies. Otherwise, they will be distributed to existing unit holders. Right. So lastly, we come to the types of abuse that can happen in the mutual fund industry. And these concepts of what we call day trading and market timing were two major types of abuse that was happening in the US markets, which there was a lot of scandal that went on with what was happening in the US markets in terms of late trading and market timing. Now, late trading, we spoke about last week, right? This is where, for example, in the US, the rule is if somebody comes and invests money after 4 o'clock on a certain day, 4 o'clock is their market close. That's why they use 4 o'clock timeline, right? 4 o'clock on a certain day, that money does not get created to the fund on that day, right? So let's say somebody comes in on a certain day, if their money comes into the fund or is invested after 4 o'clock, then they must create the units the next day. So 4 o'clock is the cutoff time. From 4 o'clock one day to 4 o'clock the next day, you can create units at that day's price. Otherwise, you have to use next day's price. Okay. So this is the rule that is there in US. And I showed you through an example, if they don't do it, they don't create units this way, that creates a problem for existing unit holders. So we did this example, if you remember, where you had prices that were prevalent on Tuesday. I think it was 10 rupees. And then, so that was Monday. And then on Tuesday, these prices went up to, I think, 10.2 rupees, right? But if the units were created incorrectly, they didn't go up to 10.2 rupees. They only went up to 10.18 rupees. What do you mean by correct creation of units and incorrect creation of units? When a person invests in the fund on Tuesday, they're supposed to get Tuesday's price. They are not supposed to get the previous day's price. If they come after 4 o'clock, they're supposed to get the next day's price. Next day's price, right? So if they came and invested money in the fund after 4 o'clock on Monday, they're supposed to get Tuesday's price. So if they didn't and they were incorrectly allocated Monday's price, then what would happen? Existing unit holders get impacted. They should have got a 2% return in the sum, if you remember, but they only got a 1.8% return. So this was the concept of what we called late trading. Late trading. And late trading, actually, there was so much penalties imposed for late trading. I believe $3 billion to that effect, to that tune, somewhere around there. Type of penalties that were imposed on these unit trust companies for accommodating large investors who are doing late trading, trying to take advantage. So hedge funds were trying to take advantage of market news after market closed by coming in at previous day's price. So therefore, what happened? The regulators imposed more independent directors. They hardened the 4 o'clock valuation rule, right? And they increased fees. Increased fees in the sense they said if somebody came in for a very short period of time, we call this rapid trading. Okay. If somebody was engaging in rapid trading, that is coming in for very short periods of time, coming in and going out, they are not coming in for the purpose of investing in the unit trust funds. They're coming in to make it's an assumption. They're coming in to make a profit that therefore there should be redemption fees imposed, and that redemption fee gets added to the fund. Right? So there were many responses that came across with these abuses. Now, market timing is a concept that comes from late trading. But while late trading is now illegal under the SEC regulations in the US, market timing is still not illegal. So what happens in market timing is where you're doing late trading, but here you're taking advantage mainly of different time zones. Because, for example, let's say you have a fund in the US. The fund is based in US, right? But its investments are made in Japanese shares. So the underlying is based on Japanese shares. Now the Japanese share market closes, you can understand, before the US share market even opens, right? By 2 o'clock in the morning, for the US share market, Japanese share market has already closed. So when it's daytime in Japan, it's nighttime in the US and vice versa. So unit trusts only get priced once. So while Japan sleeps, the US markets would have a price, correct? So let's say, for example, you have a certain day, Japanese market has closed now. So all the Japanese stocks are valued and this unit trust has a certain price, right? I don't know, let's call it $10. Now, imagine until 4 o'clock that day, 4 p.m. that day, this unit trust is going to be $10. In between this time, right, what happens is, let's say something catastrophic happens in Japan. Like, for example, you saw recently, a couple of days ago, we saw the Taiwan earthquake, right? And there were tsunami warnings for Japan. So nothing happened, but this is something like that happens, right? When that happens, you expect like something bad happens, for example, the previous tsunami that occurred in Japan, when that happens, you would expect there to be calamity when the Japanese market opens. Obviously, you expect that Japanese shares would fall, right? But the problem is Japanese market is still closed because it's nighttime in Japan and now daytime in the US. Japanese markets have not yet opened, but a calamity has happened. Right? The units in the US fund are still priced at the old prices. So investors who are aware can come and actually redeem the units at the old higher prices before the Japanese market starts to crash and the US prices start to adjust. So these types of things can happen when you're trading in, when you're buying or selling units in funds that are trading abroad, like for example, in European markets or Asian markets, right? There can be massive news that comes in, good and bad both. I took an example of bad news coming in both ways, good news or bad news. You can use that news to buy units based on stale prices. Stale meaning prices that are no longer relevant. That wouldn't have happened if you were in line with the market. Okay. So this is called market timing. It is not illegal. It is unethical because you're still putting existing investors into trouble. But because there is no way to circumvent the problem, it is not considered illegal. So these are two types of abuses that was there in the US system, for which late trading was afterwards deemed illegal, unethical and illegal, but market timing is still unethical, frowned upon, but not illegal. Any questions?
Ma'am, how an investor can sell that after 4 p.m. if the
It's not, right? So now let's say, for example, in Japan, it's nighttime. And
no, ma'am, I'm
US,
referring to late trade.
oh, late trading.
Yeah.
No, so in late trading, what happens is if you come after 4 o'clock, and you try to invest money, I mean, you can bring money and try to invest money, right? But that units will not get created until the next day. It should not. But what used to happen was the fund managers, because these were large investors like hedge funds, for future business and for relationship purposes, the fund managers used to allow hedge funds to bring that money and just sit as cash. They weren't being invested because market is closed, but they were being units were being created on their behalf. They didn't do that for small investors, but they did that for the large investors. So it's up to the fund manager to do that, right? And that's not a correct practice, which is why it was later on deemed illegal, and there were a lot of penalties and so on that took place. Is that the question you asked?
Yeah. Yes, ma'am. So since it's illegal, that
Now you can't. There is
now we can't. All right. Okay.
Oh, so that finishes the unit trust section. Let's move on to bond yields. So we jump back to bonds, right? Hopefully today and the rest of tomorrow we can finish off the bond section, because I will not be here for the next 2 weeks, which is why we're doing these two classes, these today and tomorrow. And so hopefully we can finish off the bond sections and start off on a new section once we start classes back again afterwards. So we come to bond yields. Now, what we did was we did bond valuations, right? We looked at what is the price of a bond. And we said the price of a bond is, or the value of a bond is the present value of its future cash flows. Price of the bond, or what we call the intrinsic value of a bond, is the present value of its future cash flows, right? And we said in a bond, it's very easy because your future cash flows are known. Now, sometimes this is when we want to figure out what is the maximum price we're willing to pay to buy this bond. But sometimes we see in the market, bond is trading at a certain price. Okay. The price is already, there is a market price. The bond already has its future cash flows, and there is a market price. So what is the yield of this bond? That's what we're going to talk about now. What is the return that you get when you pay this market price and you buy the bond? What is the return or the yield that you get? And for these years, we talk about for your syllabus, right? We talk about 4 different types of yields. The first 3 is about future yields. The last one is about historical evaluation, performance evaluation type, right? Historical. So the first 3 yields are about when you're buying a bond, what is the return you're going to get. The last one is the holding period yield, is about the return you actually got, actually received. Right? So the first 3 yields, nominal yield, current yield, and yield to maturity. Nominal yield and current yield are very easy. So nominal yield is actually, we define it as the coupon as a percentage of your face value. Coupon as a percentage of your face value. Coupon for the year. Coupon for the year as a percentage of your face value. This is your nominal return or nominal yield from a bond. Do you see, when I take coupon at face value is 100. Coupon is the coupon amount, not the coupon rate. The nominal yield, do you see, is equals to your coupon rate. Nominal yield is equal to my coupon rate, because what is my coupon rate? My coupon rate is my coupon as a percentage of my face value, right? Or in other words, my coupon is what? Coupon rate into face value. So nominal yield is very easy. Nominal yield is your annual interest amount expressed as a percentage of the face value or the par value of the bond. So if I buy this bond at 100 meaning the face value, what is the return that I get? This is what we mean by my nominal return. If I buy this bond at 100, what is the return that I get from my coupons? This is what we call our nominal return or nominal yield. It's equal to your coupon rate. That's very easy. Current yield takes it one step further. Current yield says, well, buying it at face, that's only if you buy it at face value, right? But you might be buying it either at face value, higher than face value, or lower than face value. So what is your actual return on your coupons based on the price that you pay? This is what we call the current yield of the bond. Current yield of the bond. The coupon for the year, as a percentage of the price that you pay for the bond. Now, if I can just show you, we know that when we talk about return is what? Your capital gain plus your dividend as a percentage of your initial investment, right? For bonds, instead of dividends, we can say it's coupons, correct? So for bonds, your return is actually capital gain and coupons as a percentage of your initial investment or price. So if I rewrite this, what is this? Capital gains as a percentage of my initial price and coupons as a percentage of my initial price. That's my return from bonds. From shares, capital gains as a percentage of my initial price, and dividends as a percentage of my initial price, right? If it was shares. This is the equation if it was shares. This is the equation if it was bonds, right? This component, dividends as a percentage of price, what do we call it? Dividends as a percentage of the price that you pay, what do we call it?
Dividend DPS.
Dividend yield, not DPS. DPS is the dividend per share. Dividend yield, right? The yield from the dividend that you, because you purchase the share at 10 rupees and you get a dividend of 2 rupees, my dividend is yielding 20%. But if I purchase the share at 20 rupees, I still get a dividend of 2 rupees, my dividend is yielding 10%. This is what we call our dividend yield. Do you see? Current yield is the equivalent of dividend yield. For shares, the income component is called the dividend yield. For bonds, it is called the current yield. So the current yield is the income component of the bond return. Income component of the bond's return. The annual interest income as a percentage of market price. So if I buy the bond at a certain price, what is my return from the income that I generate? From the income that I generate. You should understand that when you have a coupon of a 10%, right? You have a 10% coupon bond. If you buy it at 100 only, do you get a coupon of 10%? You will get a coupon of 10 rupees. Always, whether you buy it at 100 or 80 or 50 or 120, you will always get a coupon of 10 rupees because your coupon rate is 10%. Coupon rate into face value is the coupon you will get. But its value to me depends on the price that I pay. If I paid 120 rupees to buy a 20% coupon, the actual return to me is not 20%. I've paid 120 rupees to buy it. So the actual return to me is lower. So that's what current yield shows me. My income, how much is it impacted by the price that I pay? Okay. That's current yield. Now, you can understand current yield is slightly better than nominal yield. Nominal yield looks at what is the return that you get if you put on your coupon if you purchase the bond at 100 at face value. But what is the problem? I might not purchase it at 100. I might be paying 80 rupees or 120 rupees to buy this bond. So it will be different. So then I look to the next step. To make it better, I look at my current yield. My current yield says, what is the return I will get if I purchase this bond based on the price that I purchase this bond at from my income? What is the return that I get from my income when I purchase this bond at a certain price? This is my current yield. It's the income component of my return. But what's missing in my yield story when I talk about my current yield? What don't I consider?
Time value of money.
You don't consider time value of money, correct? You don't do that. What else? Even more fundamental than that? Reinvestment of the coupons. Yes. That's also connected with your time value of money. But yes, you don't consider the reinvestment of your coupons. Do you consider the capital gain return from your capital gain or loss? You don't consider that, right? You don't consider your total return. When you think about current yield is only the income component of your return, the return that you get because of your coupon. But your return is made up of two components. Your price difference which can be positive or negative, and your income, which is your coupons, right? Your price and your income. So return is made up of two things, and current yield only considers one, the income component of your return. It doesn't consider this entire thing. It doesn't consider capital gains and coupons. Yield to maturity in its basic form is essentially your capital gains and coupons as a percentage of the initial price that you pay, but after considering time value of money and reinvestment. It is the total return from your bond. Total return from your bond. All capital gains and coupons. Take into consideration all capital gains and coupons. That's yield to maturity. So yield to maturity, in very simple terms, is that. But when we do the actual calculation for yield to maturity, we essentially say yield to maturity is the IRR of your bond. What does that mean? What does that mean?
In commercial banking, we use IRR as internal rate of return.
It is correct. IRR is the internal rate of return. What does that mean though when we say it's the IRR of your bond?
The total inflows discounted.
Yes. You're taking into consideration what is the price you pay. What is the price you pay today to get these inflows in the future? Right. And then what do? You find your break-even return that makes the price that you pay, that makes the price that you pay equal to the present value of your future cash flows. What is the return that makes the price that you pay equal to the present value of your future cash flows? This is what we call the IRR, or in our terminology, the yield to maturity of the bond. Yield to maturity of the bond. And why this name? It is because when we do our IRR calculation, we make an assumption. The first assumption that we make is that we hold this bond until it matures, because we might not actually. So this yield actually gives me the return that I will get if I hold this bond until it matures. The return that you get if you hold the bond until it matures. If you sell the bond in between, you will not get this return. But if you hold the bond until it matures, you should get your yield to maturity. Right? That's the first assumption. The second assumption is an IRR assumption. The second assumption assumes that these are all in between cash flows that we get are reinvested at the same rate, which is the rate of IRR. At the same rate, which is the rate of IRR. Right? So all in between cash flows that we get are reinvested at your IRR, or in this case, your yield to maturity. Right? This is the two major assumptions that we make. So what is yield to maturity? The correct yield to maturity. I said yield to maturity is your total return. What do you mean by total return? Your capital gains and coupons as a percentage of your initial investment. That's, in basic terms, that's yield to maturity. But you have to take into account time value of money and reinvestment. the effect of compounding, right? So what does that mean? Correctly, yield to maturity is the return that will make the present value of your future cash flows equal to your market price. It is the return that will make the present value of your future cash flows equal to your market price. In other words, the IRR, which assumes that you hold this bond until it matures and the cash flows are reinvested at the same rate of return as the yield to maturity. Questions? Okay, let's try an example. I'll come back to holding period return. But as I told you, these three are about future returns, expected returns. Holding period return is about assessing what happened in the past. So these three are what we're going to talk about now. Jump that. Try example 1. Calculate the nominal yield, current yield, and yield to maturity. Sorry, Zanila, I think you had asked a question before on the previous sum. Was that answered to you or you need me to answer it? I saw it later on. Okay. Forget yield to maturity, nominal yield and current yield are very easy. What are the answers? Okay, Mihirani, your answer looks correct. Prasad, no, check that again. Remember, nominal yield without any calculations also, you can say it. You know what nominal yield is going to be. Oops. So Niraj, yes, answers look okay. Only thing is Hirani's and yours, the yield to maturity answer is slightly different. So nominal yield, very easy. Prasad, nominal yield is correct. Current yield and yield to maturity still differentials are there. Nominal yield is without calculations, generally in percentage terms. Nominal yield is simply the coupon for the year as a percentage of face value, right? So coupon for the year as a percentage of face value, the coupon is 10% annual coupon. Coupon for the year is 10 rupees, not 10%. 10 rupees. Take 10% into 100. Remember, I've not given it here, but always, if I don't give it, face value is 100. Remember, I said that before. So, face value 100. Nominal yield is 10%. Nominal yield is 10%. And that you could have done even without a calculation. You could have said that nominal yield is equal to your coupon rate, which is 10%. That's nominal. Current yield is your coupon for the year. It is 10 rupees as a percentage of the price that you pay. So how much is 10 rupees divided by 96? 10.42, is it? Is that correct? $10.42. Okay. Next part is yield to maturity. Yield to maturity. So here it's a 2-year bond, annual coupon, market price 96, face value 100, right? So technically I know that I'm paying 96 rupees today to get, and I will get 10 rupees in 1 year's time and 110 rupees. That's 10 rupees plus 100 rupees in 2 years' time. Now, what is yield to maturity? It is the R that will make the present value of my future cash flows equal to market price. So market price is 96. What is the present value of my future cash flows? 10 divided by 1 plus R squared. 1 plus, sorry, not 1 plus R squared, R plus R to the power 1 plus 110 divided by 1 plus R to the power 2. So this equation, of course, I can solve, right? With a little bit of difficulty, but can solve it, right? If I say one over 1 plus R is equals to X, then do you see that this is 96 is equals to 10x plus 110 x squared, right? So that means 110 x squared plus 10x minus 96 equals 0, right? And I can solve for x, right? That's year 6 months that you all have learned in school. But you can't do this for an equation that's 3 years. or 2 years with semi-annual coupons or quarterly coupons. Can't do it, right? So this is not the way we're going to solve it. We have to think of another way to solve it. So the only way we can do this without a financial calculator is by using approximation. So there are several steps that we will follow. Let's do it step by step. So the first thing we do in these types of calculations, step one, the first thing we do is we use an approximation. We say the first guess of R is this. So for the first guess of R, we use an intelligent approximation because you can't just say, I guess R is 10%, right? So we use an intelligent approximation, that's something that will give me an answer that's very close to the actual R. So my first guess of R is the fact that I know R is my capital gain plus coupons as a percentage of my initial investments. It's very close to this, right? I know yield to maturity is approximately that. So R is my capital gain plus coupon as a percentage. Here I don't use initial investment, I use average investment, average price, right? That's just to make the guess a little bit more accurate. So don't worry about that too much. It's just a way of making the guess slightly more accurate, right? Especially when you have long periods of time, like 10 years, 20 years, average price is better than using the initial price. So what is my capital gain? My capital gain, this has to be all for the year, right? Per year. Capital gain per year, coupon per year. What's my capital gain? In this scenario, what is my capital gain?
₹4.
4 rupees. Yes. I start with a 96 rupee bond and then I end up with a 100 rupees cash, right? So right? I start with 96 rupees and I end up with 100 rupees cash. That means I make a gain of 4 rupees by buying this bond over a 2-year period. So what is the capital gain per year on average? On average, I make a 2 rupee capital gain each year, correct? 4 rupees over 2 years. So 2 rupees over each year. So what is your capital gain? Your face value minus your initial price. This can be a capital loss also if it's at a premium, right? Divided by the number of years. Plus your coupon for the year. Coupon for the year. As a percentage of your average price. That is your starting price and ending price. Right? So that's your face value plus your starting price divided by 2 average. So how much is this? Is this 12.24? Face value, this is 2 plus the coupon is 10 divided by average price 196 divided by 2 is 98. Divided by 98 is that 12.24?
12.24.
12.24. Thank you. Okay. That's my first guess. That's my first guess in terms of what is yield to maturity. So once I make a guess, I have to verify that that guess is correct. So what do? I verify the price. Just out of curiosity, those of you who calculated yield to maturity before? How did you calculate it? Nirani and Niraj, you guys have calculated. I don't know whose is correct. Without the financial calculator, did you all calculate it in any other method?
No, madam. Same method you follow.
Okay,
No, I use the
financial calculator.
financial calculator.
So the financial calculator, the problem is, to be fair on everybody, you still have to follow. You can verify the results in terms of the final results through the financial calculator. That's because otherwise there's sometimes a certain amount of marks to look at the timing that it would take on average for everybody to do it. So because of that, the financial calculator only will not carry marks, but you can verify it through the financial calculator. That's just for fairness purposes. So you verify the price. Price is your C into 1 minus 1 plus R, right? C into 1 minus 1 plus R to the power minus N divided by R plus right. So you input your C. How much you get as your price? What do you use as your, so this was your guess, no? 12.24. So you can either use 12.24 or you can use something very close because this is still a guess, right? So you can use 12.24 or you can use something very close to 12.24, like 12.2, for example, and verify whether P is accurate. So here, let's use 12.24. So C is 10, R is 12.24. How much is that? How much are you getting here?
I got 96.2261.
Okay. 96.261. So you can see it's not the result you want. The result you want is 96, right? This is higher than 96 and it's a little bit more than what you would ideally want it to be, right? So you want to be as close to 96 as possible, even though it is an approximation. You want to be as close to 96 as possible. So we have to do another guess. So I have to make a guess 2 now. What is the second guess that you would like to make for R? Now you made one intelligent guess. What's the second guess that you want to make? Up to you. Anybody? No further.
12.5.
12.5. Why did you guess 12.5?
Because bond prices and interest rates are inversely related.
Correct. Right. So you can make another guess, but it should be an intelligent guess as well. Right. You shouldn't, your R now you have 96.22. You need the price to be below 96.22, not above. Your price has to be below 96.22. That means your R needs to be above 12.24. That's something that you need to remember. Bond prices and interest rates are inversely related. So your second guess, if you want the price to come down towards the actual price, your second guess should be above the original guess. So, okay, let's use 12.5. If you guess 12.5, use that to verify P2. Right. So this is your second guess number 3. Now verify P again. We'll call this P1. We'll call this P2 because we still haven't got 96. How much is P2? So you go back to the equation, you put 12.5 and verify P2. $95.8024. Can somebody else verify? Is that correct? Zarila 8024 or 804? Thank you, Charlie. Okay, 8024. So, great. Now we have 2 guesses and we have the 2 guesses in the way that we want to. Ideally, always remember when you make these guesses, because it is a guess, if you come to exactly 96, that's fine, right? But if you make a guess that is, so your first guess was 96.22. At that point, rate was 12.24. Second guess was 12.5. And for that, you got 95.80. This is fine because the price that you want is 96. We don't know this, but if we don't get a guess that gives us exactly 96, at least we should be able to interpolate, right? Interpolate means we should be able to find answers that are in between, right? Always, we never extrapolate. We always want to interpolate the answer. I know the answer if it's 12.24. I know the answer if it's 12.5. So therefore, at 96, what is the R? That's what I'm trying to find. I know R at 96.22. I know R at 95.280. Then at 96, what is R? But it's very important to remember when you're interpolating, what are you doing here? Now, this is the price that we want. We want to find the price. This is R at 96. This is what I want, right? I have found the price at 12.5. I found the price at 12.5 and it is 96. Sorry, how much is that? 95.80. I found the price at 12.24 and it is 96.22 or something like that. Correct? Now I want to interpolate to find the price at 96. One thing you should understand, if you try to extrapolate a certain point, extrapolate means find outside the range. If you found two prices that are on the same side of the equation and you want to find the price here, the error is much larger. So somewhere here and somewhere here, and then you want to extrapolate to find the price here, the error is much larger. So we never extrapolate. We always find two prices that are on either side of the price that we want to find. And then use that to find the R for the price that we want. So how do we do that? Using the same equation. Actually, let's use this. Sorry. And how much was this? 96 point. I don't have the figure written here. 96.22 something, right?
96.22.
22 what?
261.
Do you see here that this is approximately a triangle, right? You have a triangle here. And you have two triangles, this small triangle and this larger triangle. Small triangle and the larger triangle. So if I look at the slope of this triangle, right? What is the slope of this triangle? Slope is the change in y divided by the change in x. So for the larger triangle, the change in the y-axis divided by the change in the x-axis is the same as for the smaller triangle, the change in the y-axis divided by the change in the x-axis. So what is the slope of the larger triangle? Change in y-axis is 96.2261 minus 95.8024 divided by 96.2261 is represented by 12.24 minus 95.8025 is 12.5. So it will be a negative number there. This is equal to the smaller triangle, where the change in y-axis is 96 minus 95.8024 divided by r minus 12.5. I can use this to calculate r. How much is r? So are you all getting 12.3787 or 12.38 roughly? So this would have been the answer that you got from your financial calculator as well, Niraj, right? So very close, 12.37. Yeah, 12.37.
Somewhat.
Sorry.
No, only kind of one decimal point yeah.
Difference. So it's very close. 12.38 versus 12.37, which is the actual answer. So I hope you all are getting it. If you all are not getting it, it's remember This part is negative, right? 12.24 minus 12.5. This is negative. Otherwise, you will get something that is higher or lower than 12.24 or 12.25, which can't happen. Shall I move out of the screen? So that's the yield to maturity of the bond. I move out. So 12 point. So one thing you should start to see, to calculate yield to maturity, steps are given here, right? Always first do a approximation one, guess one. Guess one is again an intelligent guess. Coupon for the year. Capital gain for the year versus average investment, right? Average investment. Use guess one, find P1. If your guess one gives P1, it usually will not. If your guess one gives P1, then you can say, okay, I found the yield to maturity, and that's correct, right? Because what I'm trying to see is whether P1 is equal to P0. P0 is my correct P. That's the R that I want to find, the R that is relevant for P0. So I use R1 to figure out what is P1. If P1 is not equal to P0, then I have to make a second guess. The second guess should be again an intelligent guess. Is your P1 here or here? If your P1 is below P0, then your P0 is higher, right? Then your guess 2 should be lower and vice versa. So it should be a intelligent guess again. Once you do that, you calculate P2. If P2 is equals to P0, no problem, you stop it at that point. If it is not, you have to interpolate to find YZ. Those are the steps in calculating yield to maturity. Right. So let's pick up again tomorrow. We can complete it tomorrow. It's nearly 12 o'clock. Yeah, just keep these numbers ready because I want to discuss it tomorrow. The nominal yield is 10%. Current yield is 10.42. And yield to maturity is 12.38. And we'll start tomorrow with example 2. Okay. So stop there. Thanks. So tomorrow again classes for both because we won't be having classes for the next 2 weeks. Okay.
Thank you.
Thanks.
Thank you, ma'am.
Thank you.
Thank you, ma'am.